Okay, hi everyone. This is going to be the second lecture for Chapter 4. We're going to continue talking about IFRS here. So last time we ended the lecture with discussing impairment of assets. We're going to pick up today with intangible assets. And essentially an intangible, this is something that you can't see, touch, taste, hear, smell. It's intangible, right? That is to say it's not a tangible asset. And they play a big part and role in companies, right? As I have here, over 80% of the value of the S&P 500 come from intangible assets. So with regard to US GAAP and IFRS, they both take a similar approach insofar that you will recognize intangibles on the balance sheet, put them on there, in one of two situations normally. First, if you buy the intangible directly, or second, if there's like certain M&A activity, like an acquisition or two companies merge. In that case, you may recognize an intangible on the balance sheet. With regard to internally generated intangibles, under GAAP, you're generally going to expense them as they've incurred. Under IFRS, you generally are also going to expense them, but once they reach development costs, those could be capitalized. So there is a difference between US GAAP and IFRS with regard to internally generated assets. So looking here at IFRS and intangible assets, when you buy them, you're initially going to measure them at cost, what you purchased them for. We know in this situation, this is where you would recognize them because you're purchasing the intangible. If the item has a definite life, then you're going to amortize it over the useful life. So for example, maybe you buy a copyright that has 10 years left of a legal life, right? Then it has a definite life of 10 years. You would amortize it over that period. If the intangible has an indefinite life, instead what you would do is you would look and periodically test it for impairment. When you have intangibles kind of acquired the second way from a business combination, you should recognize them as separate assets apart and separate from goodwill. So basically put them at fair market value on the balance sheet. If, however, in a business combination, an intangible isn't identifiable or fair value can't be assessed, then you would include it in goodwill. So general rule is in a business combination, if you can separately identify and measure the fair value of an intangible, you should include it on the balance sheet. So this is just showing an example of that, right? Like A acquires B. It looks like there's a couple identifiable intangible assets. We place them on the balance sheet, right, at their fair value. Now, with regard to internally generated intangibles, we have to kind of separate research from development. So oftentimes you'll see R&D as one word, but they're actually two separate things. So research is the search for new knowledge. This is basically immediately expensed, whereas development is the application of knowledge to commercially viable products. With regard to development, you can either expense it or capitalize it. It really depends, have you reached the point of feasibility? In other words, in the early stages, when there's still uncertainty as to whether there's feasibility for commercial success of this product, you're going to expense development costs. However, once it becomes commercially feasible, then you're going to continue to capitalize development costs. And those capitalized costs you will ultimately amortize. So research expense, development before the point of viability expense. Once there's viability, you capitalize it. And then, once it's capitalized, you're going to amortize it. So if we look at this example here, let's zoom in a little bit. Looks like in year one, a company spends $300,000 on development costs. $250,000 were before technological feasibility, and $50,000 were after. So you can see the 250 we're going to immediately expense. The remaining 50 we're going to capitalize. Then it says in year 2, a company spends 300K more on development costs. Okay, so year 2, we're still at that feasibility standpoint. We're going to capitalize the development costs as an intangible. Then it says in year 3, the product's available for sale. And at this point in time, the company is going to begin amortization. So what that means is, right, if you look at it, we did 50 capitalized, then 300. We have 350 of an intangible amount right here that we capitalized from development costs. It looks like in this situation, they're using units of production to determine amortization. So they basically look at what percentage of the units were made in the year compared to the total amount we expect to make, 40%. That amount is going to be amortization expense. And you could see that right down here, the journal entry for it. Basically, debit amortization expense, flip out the development costs. This right here is just showing you an alternative method. If we expected this intangible to last 4 years, we weren't going to use units of production. Instead, we would use straight line. This would show you how you would amortize it in that capacity. So with regard to IFRS and intangibles, IAS 38 is going to allow for a revaluation model for intangible assets that have finite lives and that have a price available on an active market. So in this case, right, what will happen is if you were to increase this intangible because of the increase in fair value, this would be credited to revaluation surplus, part of equity, as a general rule. Now, once you have intangible assets, they should be tested for impairment, right? If it's a finite life intangible asset, you look to the facts and circumstances to see if the carrying value is going to be recoverable or not, versus if it's indefinite intangible asset, you're going to test for impairment annually, regardless of facts and circumstances. Next up, right, we have business combinations. So a business combination is the acquisition of one business, the target, by another business, the acquirer. Okay, so like A wants to acquire B. In that case, A would be the acquirer, B would be the target. Several ways you can achieve this, right, if you want to have a business combination. One might be the target dissolves into the acquirer. So B goes out of business and dissolves into A. Next, we could have the acquirer and target both dissolve and merge into a newly created entity. So maybe both A and B dissolve and then they form C together in a new entity. Or the third way you can do this, you can have a business combination, would be through the acquirer obtaining the stock of the target and both entities continue to exist. So basically A buys all of the stock of B, both continue to exist as entities, it's just A owns B. It's kind of like A is the parent now of the subsidiary B. Now, cross-border M&A, if you're talking about international accounting, this is going to be a common experience, right, for large multinational corporations. If we have a stock acquisition, right, this third way right here that we discussed, there's going to be a parent-sub relationship, and this is going to require group accounting, namely a form of consolidated financial statements. So if we're talking about consolidated financial statements, right, parent companies have to produce them for all of the subsidiaries over which they have control. Now, IFRS 10 is going to provide a single model for investees, regardless of ownership level. And when we define control, it's going to exist when we have three different elements that are satisfied. The investor has power over the investee, the investor has the right to variable returns, and the investor has actual or effective power over the investee. U.S. GAAP in distinction is going to provide two models for consolidation. They're going to have this controlling financial interest model, and then a variable interest entities model, a VIE model. And VIEs, these are entities for which the equity investment at risk is insufficient to finance its operations. Companies can exercise control over these entities if certain criteria is satisfied. So, talking about business combinations and consolidated financial statements, right? Both US GAAP and IFRS are going to provide similar accounting treatment for them. Specifically, both are going to use a type of acquisition method, right? And in these frameworks, we're going to have the acquirer and target. Obviously, they have to be identified. And upon identifying them, the acquirer, in this example we used, A acquires B, is going to record the target B's identifiable assets and liabilities in the post-acquisition balance sheet at fair value. So continuing with it, the acquisition method is going to require recognition of goodwill upon consolidation, right? Goodwill is essentially like the favorable reputation of a business, right? It's a type of intangible asset. And when we're talking about goodwill for accounting purposes, we're really going to consider two things. I have A and B here. We're going to consider A, the consideration transferred, so what we paid, as well as any amount recognized as a non-controlling interest. And then B, the fair value of the net assets acquired. So in short, right, we're kind of comparing, in short, really summed up, what we paid versus what we received, right? If A is greater than B, goodwill is recognized on the balance sheet as an asset, right? We basically, maybe we paid 500, but we only received 400 worth of stuff. That additional 100 is going to be and represent goodwill, right? However, to the extent A is less than B, this is going to be a bargain purchase. Basically, we got it for a good deal. We have to recognize a gain on the income statement. So in this case, right, if we paid 500 and we got something worth, in this case, A is going to be less than B. So 600, in that case, we're going to have $100 gain, right? So if we pay more for it, the excess is goodwill. If we pay less for the item we receive, it's going to be a gain, the income statement. So as we've indicated, right, one way you can have an acquisition is through purchasing the voting stock of the target. In this case, though, you may not necessarily buy 100% of the target, right? You could buy 100% of the stock, but maybe you don't. So in situations where you acquire more than 50% but less than 100%, we're going to have an NCI involved, a non-controlling interest. Basically what happens here on the consolidation, you're going to record 100% of the target on your balance sheet, even though you don't own all of it. So say you buy 80% of the target stock. Then what you're going to have is an NCI, a non-controlling interest, as a stockholder equity account that's going to represent the minority shareholders' claims. So for that 20%. Now, treatment and calculation of this is going to be a little bit different between US GAAP and IFRS, right? US GAAP requires the non-controlling interest to be recorded at fair value, including goodwill, whereas IFRS lets the non-controlling interest be recorded using a proportionate share method or a fair value method. So we're going to look at this portion right here, the two ways you can record and account for a non-controlling interest. Okay, so we're talking about non-controlling interests here as part of a business combination. We said this basically arises when A buys the stock of B, but they don't acquire all 100% of it. They acquire more than 50, but less than 100. And the example we used was something like maybe they acquire 80% of it, which means somebody else is owning 20%. That somebody else, we're going to call them a non-controlling interest. And how we account for it under IFRS, they give you two methods, right? The first method is proportionate share. The second method is fair value. So in this example, they're using the proportionate share method. Let's say A acquires 90% of T stock for 360 grand. The target has assets with a fair value of 320 and liabilities of 40. As we've indicated, we're doing the proportionate share method for the NCI. So the first thing we're going to do here is say what are the fair value of the net assets we've received. So we got 320 in assets minus 40 in liabilities. So the net amount of that is 280. We bought 90% of the business, which means the non-controlling owner or owners own 10%. So 10% times the 280 we just calculated is 28 grand. Accordingly, when we calculate goodwill, right, when we said to the extent A is greater than B or less than B, and we look at our consideration plus any NCI, so in this example, it's going to be what we paid, 360, our consideration, plus the NCI we just calculated, and compare that to the fair value of the net assets received, B here, we're going to have 108K in goodwill. Now, let's look at the second method here, right? The fair value method. So we'll be using the second method in this example. So same setup with facts. A acquires 90% of the stock. There's assets of 320, liabilities of 40. We're going to use the fair value method. The first thing we do here is we're going to impute a total value of the business. So if we paid 360, right, and we got 90% of it, we're going to impute a 400K total valuation of the company. We got 90%, meaning there's a 10% NCI here. So 10% of the 400 is going to be 40K. So again, if we do that same math where we can basically look at what we transferred plus the NCI minus what we received, we're going to see goodwill is 120K, right? So 108 here because we had a 28K NCI versus 120 here because we had a 40K NCI. And the reason there were differences between them is because here we used the proportionate share method and here we used the fair value method. So as we kind of discussed indirectly here, goodwill is going to be the premium a buyer is willing to pay over the appraised fair value of the target's net assets. Both GAAP and IFRS are going to require goodwill to be carried as an asset that's tested for impairment annually. Now, how they test impairment is a little bit different, right? Under IFRS, they look at the cash generating unit, a type of operating unit level, whereas under US GAAP, they're going to look at the reporting unit level, which is a broader term than CGU. Now, you can look at this. I'm not as concerned about this because this is a little bit more complex math and more, a deep dive than I was planning to do for this lecture. But you can look at it with regard to how you would be testing impairment based off whether you use the proportionate share method or fair value method. So in other words, based off of which one you used here, that can determine and control how you would test for impairment with regard to the goodwill. So this is showing you an example with the proportionate share method, how that shakes out. This one's showing you the fair value method, how it shakes out. And then finally here, we're going to end up with borrowing costs as kind of the last point of the lecture. So both US GAAP and IFRS address borrowing costs. Generally, under both systems, you're going to expense them as they're incurred. However, you will capitalize them when it's related to acquisition, construction, or production of PP&E. So basically, if you just borrow money to borrow it and spend in the normal operation of the business, you would expense the interest you pay on it as it's incurred. However, if you borrow with the intention of specifically using that money to build something, right, like a building or something, that would become capitalized as part of the building. Now, as I have here, right, IFRS borrowing costs are going to be greater than US GAAP costs. With regard to definitions here, borrowing costs under IFRS are defined as interest and other costs incurred by a business in connection with the borrowing of the funds. This includes foreign exchange gains or losses that adjustments are needed for interest costs. In short, right, the capitalized amount here, if you're going to capitalize it, when we're looking at acquisition, construction, or production of PP&E, it's going to be the weighted average of the cost of the expenditure times the appropriate interest rate. So with that, we will end the lecture here for Chapter 4, Lecture 2.